Welcome to Stifel's Sightlines podcast, focusing each week on a topic or two important to investors. Well, greetings and welcome to the Sightlines podcast. Hey, in this episode, I want to get into inflation and Fed policy, a topic that's been with us now for years, but really also introduce the idea of tariffs and what tariffs might mean as the Trump administration comes into power early next year. So let's jump into it. And, you know, one of the things I wanted to do before we get into those details is talk about one thing that I think honestly sometimes confuses people. And that is that when it comes to higher prices, you know, we've experienced certain inflation in the past with this elevated level for the last few years, and that has driven prices higher. Now, the reality is you can think of things like, I don't know, food, like eggs or bread or the cost of gasoline or something like that. And basically prices have gone up. And yeah, there may be a handful of areas where prices might decline, but overall, the Fed isn't fighting for that overall, meaning that there's not an expectation of deflation of the decline of prices. What the Fed is fighting for is disinflation, which is really a drop or reduction in the positive inflation rate driving prices higher from here. Right. So I think sometimes people think, oh, when we tackle inflation, all the prices are going to go back down. But of course, the reality is that's not the case. We all just have to sort of absorb what's happened so far, knowing that there's some specific areas that might be a little bit of out of whack and maybe will get normalized. But anyway, with that as a backdrop, the other thing that we'd say is that in the environment, what we've seen is sticky inflation. So if we look at three popular measures, certainly that the Fed keeps an eye on, let's say the core consumer price index, and again, core meaning that food and energy is not included because those two things are volatile, or core producer price index, or finally the core personal consumption expenditures price index. All three of those averaged over, and sometimes well over 2%, on an annualized basis over the last 6 months. So it's almost like things have firmed up. And so, for example, core CPI, that consumer price index, it has a rate of 2.6% annualized over the last 6 months. The core PPR, the producer price index, an annualized rate of 3.1%. And then the core personal consumption expenditures price index, what's known as PCE, averaged 2.3%. So again, not horribly bad, but still a bit above the Fed's 2% target. And in fact, when we look at break-even rates, so for example, just taking the one-year break-even, this is basically the expected inflation rate, the market's expectation of inflation priced into different kinds of bonds that you can look at the yields and infer what the market thinks. If we go back to mid-September, the market thought the one-year forward inflation rate was going to be 0.4%, so a real drop in inflation. Currently, basically, and there are a lot of factors for this, that break-even rate has risen to 2.7%. So again, the market now seeing the strong possibility of an inflation rate above the Fed's 2% target going forward. And what that translates to for the Fed anyway is more caution about rate cuts, right? And so what we see is officials out talking and saying we don't see any pressure to keep the cuts going. So, for example, Jerome Powell, Fed Chair Jerome Powell recently said, quote, "The economy is not sending any signals that we need to be in a hurry to lower rates," end quote. So they're all sort of saying, hey, we're going to slow down. And in fact, when we look at Fed funds futures, a couple of interesting data points. One is, last I looked, basically there was over a 40% chance that there would be no rate cut in December. Now, for a long time, and still the most likely outcome is a quarter point cut, but there's a building sense that they may not cut at all. And then when we look out to the future, into 2025, compared to that mid-September date when there was a view that there would be a certain amount of rate cuts, now it's basically 1% fewer cuts, a total of 1%. So think 4 quarter point cuts, 4 fewer in 2025 than originally forecast. So again, the market's inferring that there's going to be a slowdown in Fed rate cuts. Now that's, I would say, partly influenced by the fact that we've had the election. It's a clear victory for the Republicans. They'll have a unified Congress, although pretty tight majorities in both parts of Congress. But I'm sure there's overarching a view. Maybe this will be incrementally positive for the economy, a little bit more pressure on inflation. So at some level, the Fed is also probably saying, hey, let's go slow to kind of keep an eye on how things unfold under a new administration. But to get to that specific topic of tariffs, I think there's also a misunderstanding. People will sort of say, oh, tariffs are bad and they're going to trigger ongoing, sustained higher inflation. Mechanically, it doesn't quite work that way, in the sense that when you have a tariff, it basically creates a one-time change in prices. So if a tariff is imposed, there's going to be a one-time change in prices when that happens. And so, for example, with the current sort of suggested tariffs that Trump's talking about, 60% in China, 10% elsewhere, there have been a bunch of estimates out there that say prices overall would rise 0.75% to maybe 1%. And that's, again, overall one time. What we believe will happen is the administration is going to use these tariffs as a negotiation tool to basically negotiate with individual countries a better situation, whatever that might mean, right? And that once they get whatever deal they want, or whatever arrangement they want, they could well sort of back off of the tariffs, reduce them or eliminate them. And then mechanically, if that were to happen, you can think of a one-time price decline when that occurs, right? And so the punchline here is, while tariffs will have an influence on prices, it isn't like something that happens that then triggers, sustained ongoing extra increase in prices year in and year out over time. In any event, that's what we wanted to get into. So as we kind of come towards the close of 2024, we're mindful that the Fed has a long way to go to normalize interest rates. We're mindful that inflation has firmed up a little bit. There are some, newer uncertainties as it relates to a new administration and these shifts in government that we're anticipating. And so all that translates to the Fed keeping rates higher for a bit longer than maybe originally thought, with a expectation still that inflation, while remaining firm, will eventually move towards the Fed's 2% target. So it's been a long time that we've had these issues in focus, but as you would expect, they need to remain in focus as we look forward to try to anticipate where things are headed and the implications for the markets, both in terms of the bond market and interest rates, as well as the stock market. Anyway, thank you so much for listening to this episode, and we'll catch you on the next one. Take care. Thanks again for listening to Stifel's Sightlines. Be sure to subscribe wherever you're listening to automatically receive each week's podcast in your feed.